Hello, hello everyone. How are you? Welcome back to my channel, Dr. Labib. I'm Dr. Labib from Dr. Labib's Academy. Please, today we are going to cover the extension of the lecture. This is ACCA, SBR. This is chapter 5. Chapter 5 is taking a little bit longer, and my videos will be not more around 1 hour. Okay, I'm not going to take more than 1 hour, and that's fine. And this is in the series of 12. Okay, this is the sequence. That's very important. 12. This is most important thing. Okay, you can track the things as per this number. This will change if, once we reach 25, when I will extend it. And I kindly request you to subscribe to my channels, share this channel, and we have to have a global reach. That is the most important thing. Post your comments, very important. I request you all to post your comments, what you feel, what your feedback is very important. And if you find really worthy, like the channel, okay, like the video as such, okay. And press the bell icon so that whenever I post the videos, it will be there. Okay, so this is with respect to SBR chapter 5. We have done till now, till the previous session, we are talking about impairment reviews. Okay, just for our kind information, for you, what is how the reversal of the impairment loss. Okay, reversal of the impairment loss. What are the conditions? Impaired assets should be reviewed at each reporting date to see whether there are indications. Fine. Each reporting date at the end of the year, and a reversal of impairment loss is raised immediately. Okay, and if it is recognized, it has as other comprehensive income and credit to the revaluation reserve if needed. The reversal must take the value of the assets above the amount. That's what it says. When we are taking the things into consideration, we have to make sure that the value of the asset above the amount, it would have been the original impairment. Means we have to compare how much impairment has been happened, and if we are making a revaluation, if the current value is making any changes, and according to that, the depreciation would have been charged into the on the basis of current revaluation. Is it right? The depreciation charge for future periods should be revised to reflect the change carrying amount. Fine. This is where it makes the sense. Now, most importantly, this is why we have to be little bit careful. An impairment loss recognized for goodwill cannot be reversed. In a means, if it is happening with respect to goodwill, is it right? Cannot be reversed. With this point, we have to be little bit very cautious. Now, what they are said is, Boxer purchased a non-current asset. These are very, very important. Okay, very important. You be very clear about test. You are understanding concepts are clear. The questions you can solve on your own. Boxer purchased a non-current assets on 1st January. Okay, 1st January 2001. At what cost? At the cost of 30,000. As at date, the asset was useful life of how many years? Useful life of 10 years. Boxer does not revalue the asset, this type of asset, but accounts for it basis of depreciated historical cost. On 31st December 2002, the asset was subject to impairment and have a recoverable amount is how much? Recoverable amount is how much? Recoverable amount is 16,000. Now, as on 31st December 2005, the circumstances which caused the original impairment to be recognized have been reversed and no longer applicable. And here how much happening? The recoverable amount is 40,000. See, first what happened? first what happened? The recoverable amount has been decreased. What is the duration? 2 years. Then recoverable amount has been increased. Is it right? After 3 years. What they are asking, explain with supporting computations the impact on the financial statements of the two impairment reviews. Is that step 1? Is it right? Is it step 1? First we have to take the things with respect to step 1. How much is there? Step 1. How much is, see, make it a point. What is the maximum amount? Maximum amount is 30,000. Okay, the threshold is 30,000. We cannot go beyond 30,000. Fine. Step 1. How much is the year ended? We will take for the year ended 31st/12/2002. Okay, after how many years? 2 years. They said that depreciated on the historical cost. Okay, depreciated on the historical cost. The carrying amount is how much? Carrying amount is as on 31/12/2002. Is it right? How much is there? 30,000 is the historical cost. Is that 30,000 is the historical cost divided by 10 years into 2. Okay, into 2. Depreciation will be how much? Depreciation will be 6,000. Okay, depreciation will be how much? Depreciation will be 6,000. Carrying amount will be how much? The historical cost is 30,000. Depreciation is 6,000. The carrying amount is how much? 24,000. This is the carrying amount as on 24,000. Fine. My handwriting is not that much. Okay, I try to write it. Fine. Okay, no problem. Now, what happens? They have make it a step 2. Okay, make it a step 2. How much is the carrying amount? Carrying amount is carrying amount as on 31/12/2002 is how much? 2002 is 24,000. Recoverable amount is how much? Recoverable amount. Is it only recoverable amount is given? How much? 16,000. Is it right? Carrying amount is more. Is it right? Difference. Difference is what? Difference is impairment. Carrying amount is more. Recoverable amount is less. If that is the case, it is a impairment loss. How much is the impairment loss? 8,000. Is it right? How much is the impairment loss? It is 8,000. The written down value is 16,000. And what we have to do? It has to be charged to what? This has to be charged to profit and loss account as okay, profit and loss account. Fine. Now, how much is the recoverable amount? Is 16,000. Okay, this is happened. Now, coming to the second one, what happens from this is step 1. Okay, this is step 1. Fine. This is step 1. I will remove this. Okay, I will remove this. The second one is we have to take step 2. This is for when? This is for year ended 31st December 2005. Okay. Now, what is for 3 years? Is it right? 3 years. Carrying amount is how much? Carrying amount on 31/12/2002 is how much? 16,000. Okay, minus depreciation for how many years? 3 years. Is it how many years? 3 years. How many years are left over? 8 years. Is it? You have total number of years are how much? 10. Is it? Total is 10 years. We have calculated for 2 years. The leftover is 8 years. And from 8 years to 2005, how many? 3 years. Okay, depreciation for 3 years. How much? On the revised amount we have to calculate 16,000 3 by 8. How much is there? 16,000 times 3 divided by 8. It comes to how much? It comes to 6,000. Okay, it comes to 6,000. How much is the carrying amount? It is 10,000. Okay, this is the carrying amount. This is the carrying amount as on 31/12/2005. Okay, 31/12/2005. How much is the carrying amount? Carrying amount is 10,000. Is it? Now carrying amount is how much? 10,000. Now, fine, carrying amount. Now they have a recoverable amount. Is it right? They have as on 31/12/2005. Recoverable amount is how much? Recoverable amount is more. Carrying amount is less. Is it right? Recoverable amount means there is no impairment loss. Is it? No impairment loss. Fine, you put it as. Is it? Now, when you do the things as such, how much? How is it? Means it is very clear that we have to be very specific with respect to the loss. Now, what happens? How many years has been passed? 2 plus 3. How many years are there? 5 years. Okay. Now, take the things. How much we can reverse the amount? Okay. That's very important. How much the reversal can be carried forward? Okay. How much the reversal can be carried forward? What is the carrying amount as per? See, this is step 2. Fine. I am using Kaplan. Okay. Please subscribe to my channel and share this channel. Okay. You are doing best. Alhamdulillah. That's fine. Is that? Now, what is there? Now we have to know the actual value. Is it right? When we have purchased on 1/1/2001. How much we have purchased? We purchased for 30,000. Okay, how much we have purchased? 30,000. Depreciation for how many years? 5 years. 31/12/2005. Okay, 30,000 times 5 by 10. It comes to how much? 15,000. Okay, it comes to how much? 15,000. I'm little bit slow. Okay, 15,000. Is that? This is the carrying amount as on 31st December 2005. Okay, 31st December 2005. What is the carrying amount as per the reversal value? The carrying amount as per the reversal value is how much? 10,000. The carrying amount as per the original cost is how much? 15,000. Fine. The carrying amount actually it is the value as on, if you take the original value, is it right? The first value, what will happen? The carrying amount is how much? The carrying amount as per 1/1/2001. Okay, 1/1/2001 value is how much? When we are doing this is on 31/12/2005. The carrying is how much? 15,000. Fine. Now we have another one. Is that this is related to this? Okay. This is related to this, and this is related to this. Okay. Now what is the carrying amount? carrying amount as per the reversal, okay, as per the revaluation, okay. The step 2 is that step 2. How much is there? It is 10,000, okay. What is the difference? Difference is 5,000. Means this much is the reversal we can do. See, the value as on 31st December 2005 is how much? 15,000. We cannot go beyond 15,000. Okay. The reversal, what we have to do? The reversal of the loss is how much? The reversal of the loss, is it right? To be recognized, okay? To be recognized is how much? Is only to the extent of 5,000. Right? So only to the extent of how much? 5,000. As simple as that. Is that? Otherwise, what will happen? You are increasing the value. It is for no other reason. Is it right? How we have to do? We have to increase the value of the asset, and we have to show it as a gain. Okay, we have to, what we have to do? We have to increase the increase the value of the asset by debiting it. Is it right? By debiting it, and increase the profit and loss account. Is it right? Because of the gain. Is it right? When the value of the asset is increasing, it has to be credited to profit and loss account. How much we have to make a credit of how much? 5,000. Here we have to make a debit of how much? 5,000. Fine. This is an original impairment. How much is the original impairment? We have a original impairment. Is it right? Step 1. Is it right? Step 1. Original initial impairment. Is it right? Initial impairment is how much? Initial impairment is 8,000. Is it right? Initial impairment is 8,000. It cannot be reversed. Is it? See, this is a very basic understanding. First means the how we are working it out very clearly. We have to take on the current carrying amount, we have to calculate depreciation. Next, if there is any increase in the value of recoverable amount, we cannot recover more than the carrying amount. Okay, more than that always we have to keep track of that as such. Fine. This is the one of a small example of reversal. Fine. On we are talking about, now we are making two things. Okay, one, we are talking about a cash generating unit and impairment reversal. On 31st December, impairment review was conducted. Cash generating results were as follows. Carrying amount is there, impairment is there, carrying amount positive. See, you see the thing. Immediately, the moment there is impairment, first target will be on the goodwill. Okay. For if there is impairment loss, straight away we have to make things clear with respect to goodwill. Property, plant, equipment is 300, impairment is 120, the balance amount is 400 minus 220. Now, what they are giving, the property, plant was original purchase for how much? 400,000 on January 1st. And what is the attributed useful life of? 8 years. On 31st January 2003, means 1, 2, 3, after 3 years, okay? After 3 years. The circumstances which caused the original impairment are reversed and no longer applicable. The recoverable amount is how much? The recoverable amount is 420. Explain with supporting computation the impact of reversal on the financial statements for the year ended 31st December. The rule says that it has been told here, I have mentioned, an impairment loss recognized for goodwill cannot be reversed in a subsequent period. Okay, here goodwill has been impaired 100. It will never be replaced. Okay, it will never be going to be reversed. Okay, now solution. Right? Point number 1, goodwill impairment cannot be reversed. The impairment of what? The impairment of property, plant and equipment, is it right? Can be reversed subject to conditions. Okay, can be reversed. This is reversed to limiting to what? Limiting to the carrying amount. Okay, we cannot reverse the actual amount. Is that we have to compare how it will happen over the time period, and according to that we have to make a reversal. What is the carrying amount of goods? See, what is the when they have property purchased on for 40,000, is it right? Property purchased for 40,000, for how many years? It is for 8 years. It is for how many years? It is for 8 years. See, they have given this value. This one is when this is on 31st December 2002. Okay, this is 31st December 2002. Fine. This is very, very crucial. They have given for 31st December 2002 and they are asking for 31st December 2003 for 1 year. Is it right? Means if the property, plant, equipment is for 8 years, this happens from 1st January. Okay, 1st January, see, 1st January 2001 till 31st December 2002, 2 years, is it right? Is already over. Okay, remaining years are how much? Remaining years are 6 years. Is it right? Depreciation. Is it right? Depreciation for if you take into consideration the carrying amount. Okay, 1 minute. If you take into consideration the carrying amount. Okay, carrying amount as on carrying amount as on 31st December 2003. Okay, 2003. How much is there? Is it 1 minute? 180 times, is it right? How much is there? 180. Okay, 180,000 times how many years have been there? Remaining years are 5. Total number of years are how much? 6. It comes to how much? Carrying amount is 150,000. Okay, carrying amount is 150,000. If the goodwill has not been impaired, okay, if the goodwill is not been, if the property, plant and equipment is not been impaired, what is the value of the plan? Original purchase is how much? Original purchase is 400,000. Is it right? Original plant is how much? 400,000. If property, plant and equipment had not impaired, we want to know what is the value. This is another way, shortcut. It is right. It is another short way. 400,000 times how many years? It is for how many years are left? 5 years. Total number of years are how much? 8. Okay, total number of years are how much? 8. This is the way we are doing for the first time. Don't get confused. Okay, times 8. It comes to how much? It comes to 250,000. You see, if it is not impaired, it is 250,000. Is it? If it is taken with the current means, if it is the maximum amount, fine. This is the maximum amount. Is it? This is the maximum threshold we can put it. Is it right? Maximum threshold. How much is that? 250,000. Now, what is the carrying amount as on 31st December 2003? 150,000. Fine, 150,000. Now, how much is the gain, or how much we can increase? How we have to do? 1 minute. Carrying amount as on carrying amount if PPP is not impaired. Okay, if PP is not impaired, how much is there? 250,000. Carrying amount carrying amount if property, plant and equipment is impaired. How much is there? 150. How much is the difference? Okay, always I will write difference. Difference is how much? 100,000. Is it right? Difference is 100,000. This is nothing but gain. Profit and loss account should be credited. Again, I will say this very simple one. See, very simple. They have given this. We cannot impair the goodwill. Keep goodwill aside. We have the as on 31st December 180 for 1 year. See, if you take that also, it will be like that only. Is it right? 180 times 180 divided by 6. Is it right? 180 divided by 6. It comes to how much? 180 minus 30. It comes to 150. Okay, it comes to 150. There is nothing like. Don't get confused that how we got this. You do in that way or you do in this way. Is it right? Or I will put like this. Is it right? We can put like, we can do like this or we can do like that. Both are same. Okay, both are same. Fine. This is the way we have to make the reversals, and we should know how the gain or loss to be treated, as we have done with respect to disclosures. Is it? Impairment losses recognized during the period we have to disclose. Any reversals we have done, we have to disclose. What is the amount of loss or reversals in the events it is recoverable of the asset in terms of cash generating units, and most importantly the fair value hierarchy. This is little bit challenging. Is that fair value less cost to sell? We have to be very specific. What are the, how we have to follow, as simple as that. When we are talking in terms of disclosures, how, what is this, how we applied the criteria. Fine. This is the simplest way. Fine. Now, what the next one is what? IFRS 5. See, it's a very lengthy chapter. Okay, we have to take. I'm very little bit slow. Very simple. Okay, this is the way I will teach. We are talking about IFRS 5, non-current assets. We have done, if you remember rightly, we have done in, I think, chapter 3 or chapter 4. Okay, we have done in chapter 4. IFRS 5, non-current assets held for sale and discontinued operations. See, when it is there are very specific conditions, is it right? It is a carrying amount to be recovered primarily through the sale transaction. What is the disposal? Is a group of assets that the entity intends to dispose in a single transaction. These are the conditions. Fine. These are the conditions which were the item available for immediate sale in the present position. The sale is highly probable. Management is committed to plan. Any active program to locate the buyer is initiated. The item is actively marketed at a reasonable price with the current value. The sale is expected to be completed within 1 year. It is likely that the plan will change significantly or will be. It is unlikely that the plan will change significantly or withdrawn. Means if these conditions are, if any one of these conditions is not satisfied, then it is not related to IFRS 5. Assets are to be abandoned or wound down gradually, cannot be classified as sale because carrying amount will not be recovered through sale. Means assets are abandoned or wound down gradually, cannot be classified as means when we are talking about abandonment means the asset is of no use. Okay, those types of assets will not be classified under the category of IFRS 5. Okay, IFRS 5. Now, there are given two conditions. This is the way we will work. Okay, I told you this is the way. The best part is this: they will explain you the concept. They will test your understanding with a theoretical concept, and they will test your understanding with a application ones. Okay, so that you will have a very balanced view. HISOP is preparing financial statement. On 1st December, the entity became committed to plan. Committed, okay? This is one of the conditions. Even one condition is not satisfied, it is not for sale, okay? Is it right? Committed to plan to sell a surplus property and already found a potential buyer. On 15 December, a survey was carried out and it was discovered that the plant had dry rot and substantially remedial work would be necessary. Is it? The buyer is prepared to wait. Means it is not going to be during the current period. Is it right? It's not for the current period. See, I will put the things. Is it right? This is point number 1, 2, 3, 4, 5, 6, 7. Okay. What it says, they have said that the item is available for immediate sale in the present condition. Is that immediate sale? It is not immediate. The condition one is not satisfied. Is it right? Condition 1 is not satisfied. We cannot, the buyer is intended to wait for the period work to be carried out, but the property will not be sold until the problem has been rectified. Definitely, if that is the case, it cannot be classified as held for sale as per IFRS 5 very clearly. Okay, can properties classified as held for sale? No. Okay, now A subsidiary entity P is for sale at a price of 3 million. There has been some interest from prospective buyers, but no sale as of yet. One buyer has made an offer of 2 million, but the directors rejected the offer. The directors have just received advice from their accountant that the fair value of the business is 2.5. They have decided it to reduce to a sale price of B at the moment. Is it? One buyer has made an offer of C. The sale price is 3. Is that see the thing? What they say, go with the things. Is it right? Point number 5. The item is being actively marketed at a reasonable price. Got my point? At a reasonable point number 5. Okay. Point number 5. I will put like this. It will be very clear for you. Point number 5. Okay. What sale value is how much? 3 million. Okay. The subsidiary is for a sale at a price of 3 million. And there is an offer of how much? 2 million. They agreed to buy. One buyer has offered 2 million. But they said that the fair value of the business is how much? 2.5 million. Is it right? Now, what point number 5 says? The item is being actively marketed at a reasonable price. See, it is in millions. It is not a small amount. Is it right? It is not. And they said that, but no sale as of yet. Is it right? We are trying to locate the buyer. Is it right? We are trying to locate the management is committed to plan to sell the item. Okay, fine. The active program to locate the buyer is initiated. Is that? But it is unlikely that the plan will be changed. Fine. That is not the case. The sale is expected to be completed within 1 year from the date of classification. So it is everything is fine, but it is not a reasonable price. They have the actions to locate a buyer in place. Okay. There is a buyer, is right? But what the problem is, it has been struck with the. Now, can the subsidiary be classified as a held for sale? No. You have to give reasons. Okay, you have to give reasons whenever it is going to be violated. Are you clear about this? See, that is the reason I have made this point. What is the rules and regulations? Okay, what are the conditions that has to be identified whenever a asset is held for sale as such? These 7 points. Okay, I am putting. See, this is I am putting it an star mark, and I will put it in the. Okay, wherever in my notes it is like this. It means these are the important things. These are the important things as such. Are you clear about this? Fine. Next. Item measurement of item assets and disposable groups held for sale. Is that what they said? Items classified as held for sale should be, according to IFRS 5, measured at the lower of the carrying value amount and fair value less cost to sell. When fair value less cost to sell is lower the carrying amount, it has to be written down as an impairment loss. We have done this. Is right? If the non-current asset is measured as a revaluation model, it means the criteria it could be classified as held for sale. It should be revalued to fair value immediately before it is classified held for sale. The difference in the selling cost and these should be charged against the profits in the period. When the disposable goods is being written down, fair value less cost to sell, there will be impairment loss. It reduces the carrying amount of the asset. What we have done in IAS 36, is it right? The same thing has been a summary of this. A gain can be recognized in subsequent increase in fair value less cost to sell, but not in excess of cumulative impairment loss. Is that we have done somewhere, we have done with respect to that 8,000, is it right? With respect to the 8,000. Is it? I will tell you that 30,000, 30,000, 6,000. Is it? We have done in one of the questions just now. 24,000. The valuation is how much? 16,000. The 8,000 is the impairment loss. Okay, cumulative that has been recognized when the assets were written down value less cost of sales. An asset held for sale is not depreciated. Understand what? These are the way. If you have identified a asset held for sale, it is not depreciated. Even it is still being used by the entity. Is it? Even it is still being used by the entity. Fine. What they say? On January 1st, AB acquires a building for 200,000, expected life of 50 years. 31st December, AB put the building up for immediate sale. Cost to sell the building was estimated 10,000. Outline the accounting treatment of the above. The building has fair value of at 31st December 2004 220 and 100. On 1st January 2001, okay, they have acquired for how much? 200,000 with the expected life for how much? With the expected life 50 years, okay. And on 31st December 2004, okay, they have put it for building for immediate sale. Is it at immediate sale? Cost to sell the building is how much? Cost to sell the building is, cost to sell is how much? Cost to sell is 10,000. Is it right? Cost to sell is how much? 10,000. Now, for these, for 2001, 2002, 3 and 4, how many years are there? 4 years. Is it right? 4 years we have to calculate depreciation. Okay. How much is the value? 200,000 times 4 divided by 50. Is it right? Times 4 divided by 50, or 200,000 times how many years are left? 46. Is it right? 46 divided by 50. Yes, this is right. This is more important. Okay. This is see you can see this is carrying amount as on 31st December 2004. Is that 200,000 times how many years are left after 4 years? 50 minus 4, 46. Total number of years are how much? 50. Is it right? This is very easy. Okay. Is it? This is very easy. We can do like this. Okay. It makes sense. It makes sense. Now, how much they are saying? They are saying that point number A. Okay. Point number A. Point number A. Fine. This is the carrying amount, as this is the carrying amount as on 31st December 2004. Now, how much they are planning to sell it? They are planning to sell it for 210. Okay. They are planning to sell it for 210. What is the building fair value is how much? Building fair value is 220. Okay, 220. Cost to sell is how much? Cost to sell is how much? 10,000. Okay, 10,000. 210. Is it right? 210. Fine. 210. What they are asking us, what is the above if the building had fair value? Is it right? This is the fair value of 210. And what is the carrying amount? Carrying amount is how much? See, carrying amount is 184. Is it right? Cost to sell is how much? Fair value less cost to sell. Is that fair value less cost to sell? Is it right? Fair value less cost to sell. What the condition says? What the condition says, 1 minute, it has been given, is it right? Items classified held for account measured at the lower of the, see, what they say, this is, see, you make it a point, is that items classified as held for sale should, according to IFRS 5, be measured at the lower of their carrying amount and fair value less cost to sell. Fine, it is very important. That is the reason I am taking this based on this condition. Okay, based on this condition, is that we have to take the lower of the cost. Lower of the cost is how much? 184. Is it right? Means 184 means we have to take this one. Okay, as per this condition. Okay, as per this condition, the building will continue lower of the carrying amount and the fair value less cost to sell. Is it right? A building will continue to take value at how much? 184 based on this condition. Again I am saying items classified, this is one. Okay, this is one, you don't get confused. Items classified as held for sale should, according to IFRS 5, measured at a lower of the carrying amount and fair value at the lower. They are giving the stress on that. Okay, is it okay? Are you fine about this? Yes, fine. This is point number A. Okay, what is the point number B? Point number B is how much? How much is the carrying amount? Carrying amount is how much? Carrying amount as on 31st December 2004. We have calculated already. How much? 184. Is it right? Fair value less cost to sell. Is it right? How much is the fair value less cost to sell? 110 minus 10,000. Is it right? It comes to how much? It comes to 100,000. Is it right? Is it? How much? See, carrying lower the value. In this case, which value we have to take? We have to take 100,000. Is it right? In this case, which value we have to take? We have to take 100,000. Is it? We have to take one. What is the impairment loss? If that is the case, how much is the impairment loss? Impairment loss will be how much? Impairment loss is 184 minus 100. It comes to 84,000. Is it right? Where we have to measure on what? We have to measure whichever is lower. Is it right? In the previous case, we have taken 184 because 210 minus 210 compared to 184, 184 is less. Here we are comparing 184 compared to 100,000. 100,000 is less because whichever is lower, that is the one of the preconditions. As per the this preconditions, okay, this condition we are going to satisfy. Is it, how much is the loss? Impairment loss is 84,000. It has to be charged to profit and loss. Okay, it looks very specific. See why we are doing? We are just working out on this rule. Fine. hopefully with this we are completing this chapter, chapter 5. Chapter 5 is taking a longer time, okay? Chapter 5 is taking a longer time, and fine, it happens, no problem. Nash, okay? Nash purchased a building for its own use, 35, okay? We will make like this. Is it? This is the solution for this. Solution for test your understanding 16. Nash wants, see what happens on 1/1/2001. They have purchased building for 1 million. Okay, and what is the how many years? It is for 50 years. Nash uses revaluation model to account for buildings. On 31st December 2002, the building was revalued for after 2 years. Okay, after 2 years, the building has been revalued to how much? 1.2 million. Okay, on 31st December 2003, the building met the criteria to be classified for held for sale. Okay, and what is the fair value? The fair value is 1.1 million. Okay, and the cost to sell is how much? Cost to sell is 50,000. Okay, 50,000. Nash does not make a reserve transfers in respect of the. Discuss the accounting treatment of the above. Is it right? Discuss the above. Now we will follow the things. Okay, you do in either way. Things are very simple. Okay, things are remain same. Okay, now carrying amount. Okay, carrying amount as on 31st December 2002. Okay, 31st December 2002. How many years are there? 50 years. 2 years are over. Remaining years are how much? 48. Okay, 1 million. Okay, 1 million times 48 divided by 50. Is it right? 48 divided by 50. It comes to how much? 960,000. See, some people will have doubt. Okay, 1 million is the value. Okay, for 2 years depreciation. Is it right? Divided by 50. It comes to how much? It comes to 20,000. Is it right? It comes to for per annum. Okay, if it is for 2 years, 40,000. 1 million minus 40,000. It is also same. Okay, I prefer, I suggest, it is my only suggestion. If you are comfortable, you can work it out. Okay, how much is that? It is 960,000. Okay, now they have revalued. Is it right? They have revalued when? They have revalued on 31/12/2002. Is it right? They have revalued on 31/12/2002. How much they have revalued? They made a revaluation is how much? Revaluation is 1/200, 1.2. Okay, carrying amount is how much? Carrying amount is 960. Is it right? What is the difference? Difference is 411 minus 240. Is it right? This is gain. This is gain on revaluation. Is it right? Gain on revaluation. This has to be shown in profit and loss account in other comprehensive income, and in the statement of financial position, other components of equity. Is it right? Other components of equity. Fine. Now, fine. This is one step is over. Now, 31st 12/2003. Okay, carrying amount. See, carrying amount on 31st/12/2003. Okay, how much is the revaluation amount? Revaluation is amount is 1.2 million. Is it right? How many years are left with us? Is it right? 1.2 1.2 divided by 47/48. 1.2, is it right? 1.2, how many years are 1.2 3/50. 1.2 1.2 is how many remaining years are there? 48 years, is it right? 48 years are remaining. 48 years are remaining. 48. 1.2. Fine. 48 years are remaining. 1.2 divided by 48 years. Is it right? It comes to depreciation will be how much? Depreciation will be 25,000. Okay, depreciation will be how much? Carrying amount will be how much? 1,200 minus 25,000. It comes to 1,175. Is it right? It comes to how much? It comes to 1,175. Now, how much they have made the things here? They said that on 31st December 2003, the value is how much? 1.1, and cost to sell is how much? Cost to sell is 50,000. Is it right? Cost to sell is 50,000. 1.1. Okay. What is the carrying amount? Carrying amount is it right? Carrying amount is how much? Carrying amount is, this is all it takes into consideration. 1 minute. Okay. Carrying amount is how much? Carrying amount is 1,175. Okay. They have calculated the fair value. Is it right? Fair value is how much? Fair value is 1.1. Cost to sell is how much? Cost to sell. Is it right? Cost to sell is 50,000. Okay, cost to sell is 50,000. Means how much how much it will come? It comes to 1,050. Is it right? 1 minus 50,000. 1,050. Is it 1,175? Okay, 1,175. How much is the loss? Loss is going to be 125. In this loss, you have to divide. Is it right? 50,000 is cost to sell. Is it right? 50,000 is cost to sell, and 75,000 is the loss. Is that 50,000 is the cost to sell and 75,000 is the loss. Fine. This is where we have to see, very simple. It is a basic mathematics. Whatever the revaluation amount will be there, on that revaluation amount, that will be there for the basis for depreciation, and subsequently we have to whatever the carrying amount, fair value, cost to sell, deduct it, whether it is plus or minus. According to that, we have to give the treatment. Okay, these are important concepts. These are 16 test your under. How many test of your understandings are there? Test your understandings are total how much? There are total 16 are there. Is it right? All 16 has to be very, very thorough with that. You do the concepts, things will be easy for us. Okay. What it says present, how we have to make a presentation. Is it right? It is held for sale should be presented separate. Any asset held for sale should be presented separately from other assets. The liabilities of the disposable group classified for held for sale should be presented separately. And the major classes of assets and liabilities classified held for sale should be separately disclosed. Means you have to do everything, you have to identify it separately. When an asset or disposable asset is classified as held for sale after the reporting date but before the financial statements, details should be disclosed in the notes. And this is a non-adjusting event. If you have done auditing, is it right? Now you will come across the auditing, adjusting events and non-adjusting events. Fine. This is the format of presentations. Change to a plan for sale. If the sale does not take place within 1 year, IFRS says that the asset can still be classified as held for sale. The delay can be caused by different situations. Is it right? Beyond the entity control. There is a sufficient evidence that continuity is still committed for a sale. If the criteria for held for sale is no longer met, the entity must cease to classify the assets or disposal as held for sale. The assets or disposals must be measured at the lower of the cost. Okay, recoverable amount. Same thing with respect to disclosures. A description of non-current assets, what are the facts and circumstances, sale or expected sales, and if there is any impairment losses or reversals. Fine. This is the complete chapter 5 non-current assets. Is it right? Be very clear on this. It takes make it a point that you revise this, because we have done so many. We have done IAS 16, IAS 20, IAS 23, IAS 36, IAS 38, IFRS 5. Is it right? We have done IFRS 15. Is it? We have done IFRS. Is it? We have done comprehensively. Is it? This takes into consideration so many different concepts. So revise it. This series complete consistently. Once we have done this, we will start the next one. Okay, I kindly request you all to subscribe to my channel, share this channel and post your comments, very important. Okay, thank you so much.